Hey guys, Sabrina, your mortgage lender here. Today we're going to talk about your debt to income ratio. What is it? Why does it matter? Why do you need to know what it is? So, debt to income ratio explained. Number one, it has to do with your monthly obligation. So, when we're doing an application for a home loan, two of the biggest critical pieces of information we're getting is your income and then your credit obligations. So, that comes when we are running your credit. We're not just looking at the scores, we're also looking at the monthly obligations that you have. So your car payments, your credit card minimum payments, student loans, installment loans, anything that's going to show on your credit report, that is going to come into a factor in your debt to income ratio. I would also add that if you have any collections account, as long as they're older than a year, those won't necessarily disqualify you from being qualified for a loan. However, collection accounts, even if you have not paid on them in years, if they are sitting on your credit report, you will get hit with a 5% of the total balance as a payment that will go towards your debt to income account or debt to income ratio. I'm sorry. And that is a big reason why, if you are looking ahead and you're planning ahead, one of the biggest things that you can do to help improve your credit would be to look at any collection accounts if you do have them and get those babies settled as soon as you can. Get them knocked off. Get them away. That's going to give you more buying power in the end, especially if they have larger balances. And often you can settle those for much less than the balance that's showing. Why it matters to lenders. So depending on the program that you are looking to get qualified for, every program is going to have a maximum debt to income ratio. So wherever that debt to income ratio hits you based on the rates, based on your income, based on your debts, with current interest rates in the market, that is going to give us or help us determine what your maximum loan amount can be. So huge amount, that's the amount that goes on your pre-approval. That's the amount that sets your budget for shopping for homes. That is why it matters. And ways to improve it. The biggest thing that I said, actually, I already kind of went into this one. If you have collection accounts, get those babies settled or dispute them, get them removed from your credit report, whatever you can do. And then the other big thing would just be to get accounts paid down as much as you can. Get your utilization paid down so that your monthly payments are lower for credit cards. And if you do have any smaller balances on accounts, especially if you're at least 2 or more months out from being ready to actually do your credit pull and finish your pre-approval, pay off those cards. Pay them off, get them zero balance. So even if it's a $40 minimum payment, let's say, or a $25, that's still going to eat into your buying power. So if you have small balances on credit cards that you normally sit revolving, pay them off and let that zero balance update on your credit report. So anyhow, lots of information, a little bit of time, but I hope that helps. If you have specific questions or scenarios that I can answer to help you with your goal of buying a home, please reach out today. There are links in the profile, or my phone number is on this slide. You can email me, you can call me, you can text me.